Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. Real quick, give us a follow on Twitter at Tusk Media LLC. We're also on Facebook, facebook.com/Tusk Media LLC. Lots of videos and live content on those forums. But in the interim, I am Andrew Hall. Joining me, Benjamin Nye. How's it going, Ben?
I'm doing well.
Good. Let's jump in today. We're talking about a plan that was proposed, I guess, yesterday on the 28th of March by Greenlight Capital, David Einhorn's group, to split General Motors into two different classes of stock. So the long and the short of it is that they feel like there's some untapped value there, and they said, hey, here's a way, as shareholders, and they are shareholders of GM, we are as well, here's a way that we can tap into some unrealized value and maybe some inefficiencies in terms of what the market's seeing versus what's actually there with General Motors. And they said the way that we can do this is to split it out, have one dividend paying stock. So the dividend goes with one portion, share gets issued, the rest of the company basically is a capital appreciation stock. Then, initial impressions of this plan.
Well, it kind of reminds me of what Einhorn and his firm tried to do with Apple a few years ago, before Apple was paying a substantive dividend. Greenlight proposed that they create a new class of shares called the iPrefs. So I guess they were a preferred stock.
Yeah.
And that would pay a strong dividend and basically leave Apple as the appreciation. And they tried a similar approach with GM here. And part of me wonders if he really tried to actually get this to go through, if he actually thought it would go through,
right,
versus just trying to shake things up a little and try to get GM's share price higher, because it has been mired in this range for a long time.
A really long time. And they have a presentation. You can find it probably in a number of places, and maybe we can even put the link in the article to the presentation. I don't know how the technicals work, but what was interesting to me is he makes solid points as value investors that we value about the company. Some of the things that they talk about is, hey, it's the lowest PE in the S&P 500, pays a pretty respectable dividend north of 4%, but the payout ratio is still really low. They basically say all of these things, but none of those things necessarily, I guess none of those things necessitate splitting the stock.
Right.
Those things are still true, and if you split the stock, they would remain true. What was interesting to me is how he basically made a case that people misunderstand GM. Some people are owning it for the dividend, and some are owning it for capital appreciation. I mean, we kind of joked about it yesterday on the live podcast, but the stock hasn't been appreciating.
Right.
So it's a hard case to say that people are owning General Motors, a mature company like that, as a growth company, so to speak.
Right. The piece of it implies that people don't know that GM is cheap.
Right.
And, on traditional metrics, the reason GM trades where it is because a large portion of the market thinks that this is the most GM is going to earn, this is peak earnings, this is the top of the cycle, and that, maybe they're going to earn $6 or $6.30 or whatever in 2017, but there's also the potential that they could earn $3 a share, which they earned as recently as 2014. And so, although Einhorn makes the case that the payout ratio is quite low, it's 24%, but that payout ratio could go easily above 50%
real quick
if we just went to 2014 levels, which was not a bad year for GM at that point. I think if you look back at that year, you would say, wow, GM actually had good performance in 2014. Yeah, they were looking at trying to get back to 10% margins in the North America region, but they were on the path to do that. I think Mary Barra had come in right around that time too.
The other thing I think that's interesting, when you start to look at this plan, and again, whole idea, just splitting out, hey, let's move the dividend over here, let's have capital appreciation stock over there. The other thing that kind of stood out to me, and the thing that kind of lends itself, in my opinion, to imply that this was almost more a shake-up, a publicity stunt. Let's start talking about GM. Let's get some attention on a stock that we believe is cheap. the reason I think it was kind of a shakeup as opposed to a legitimate proposal that they expected to go through, or at least have an attempt at going through, is when you look at the premise of the split, it's so simple that the reality is you could apply that. If it was logical for GM, you could say, well, every cheap stock that pays a dividend, well, let's split it, and that's going to unlock value. I mean, if the formula was that simple, this would have been done time and time and time again, and it would get replicated time and time and time again, and every dividend-paying stock you have would suddenly move over, and income investors would drive the price of that up. Right. And every appreciating, growing business would be there, and it would be its own thing. But the reality is, it's just that doesn't magically unlock things. I think that was what was interesting to me, was really kind of the gap in terms of the value they thought that this would unlock. Again, we're talking about the same company. It's not like GM was going to add a company.
Yeah. The problem I think that is inherent in this is that you have if you look at the 2046 bonds for GM, I think they trade at a yield of 5.5% or thereabout, yield to maturity. So you could say that essentially a perpetual, not even a preferred stock, but a perpetual stock or perpetual bond. It could be between 7 and 9%. You have massive duration risk, and you have credit risk on top of that. So 7 to 9%, I think that might be aggressive, but there's a legitimate case that you could be made. Yeah, maybe they can get there. But then you look at back out the value of the rest of the company, and you still end up in this situation of, well, now you not only have an even a more concrete obligation than you had before to funnel that $1.52 per share to the GM dividend shares, but that also reduces the amount of flexibility you have above the positive operating margin. So instead of making $6 or $6.50 or whatever they're going to make $4.50 or $5. And then if they made 2014 earnings, now they're making $1.50, and you can't put and if that's kind of mid-cycle, you put a 10 multiple on that, you're talking $15 a share, not 33 or whatever he was talking about.
Yeah, that's what, again, just kind of a bizarro theory in my mind. If you read this as something that was a legitimate attempt, the stock is trading at high $35 range right now. Was kind of trading in that range yesterday as well. It was up. I mean, this got some headlines, but what was wild to me was he said, "Hey, we're going to cut the dividend out, and we think this standalone capital appreciation stock is worth as much as $38." Which is, again, just kind of insane to think.
Right, and with GM, you do have there are just a lot more cyclical. There are a lot more risks in GM than you'd have at a less cyclical business. I mean, if Macy's wasn't going to split off the real estate and do a REIT, and pay the dividend and leave the Macy's appreciation shares, for lack of a better term, I mean, it's really difficult to see someone like GM doing that. You could say that Philip Morris should do that, or Altria, but they're not. And especially when you consider that there might even be tax benefits if they could somehow incorporate the GM dividend or an Altria dividend share in Ireland or something. Then you'd have the tax benefits from that. But even they're not doing it. So why would someone like a GM find that appealing to them? And they also have the risk with credit downgrade potential.
So we've seen a short-term Einhorn bump, so to speak. Stock is up a little bit. Do you see this? Is this a tipping point where people start to actually look at this stock and start to unlock value in GM the way it is actually viewed currently and the way it's currently structured, or do you think it's just kind of a blip in the radar?
I think in order for GM shares to go up materially further, I mean, it's just been in this range and
for 4 years.
For full disclosure, and full disclosure, like I've been long GM for a large portion of those 4 years, and just continually frustrated. Every time it gets up to 36, 37, I get excited. Maybe it is going to be the breakout time, and maybe this could be the breakout time. But I think in order for that to happen, they'll have to have just a sea change and a paradigm shift within the investment community, and that is that no, this is not peak earnings. Earnings are going to continue to grow, and they could grow to $8, $9, $10 a share. And that has to be the thinking, whereas right now this is now peak cycle, and where the same reason that GM stock is so cheap right now on just a cursory basis is the same reason that Caterpillar's stock is so expensive. And that's because the investment community is not looking at what the company has done, but is projecting what the company will do and where they are in the cycle.
Yeah, I think that's a great point. Is really just the mindset has to shift.
Yeah.
The market's mindset has to shift. And again, I don't know that would have happened if they split the stock into two different share types. Anything else? Any closing comments?
No, it'd just be interesting to see if this discussion continues, or if Einhorn just kind of lets it be. It seems like at least he'll want an audience with management, and I think Mary Barrett is. She's astute enough to grant that and sit down, and I think that will continue to be. There will continue to be noise in this area. I'm not sure if it'll actually result in something, in a compelling, meaningful change at GM.
Right. Yeah. It'll be interesting. Get those two in the room, see if anything comes from it. But again, he's at least starting the conversation, and maybe that's good for the stock. We hope so. Again, we are long GM. This is the Investing Podcast. Thanks for being here.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.